not for the company that I'm trying to value. But this is for another company that I'm trying to value, separate from assignment. REITs.
Yeah, what about it?
Valuing as the sum of their parts, or as of their assets, or valuing based on
an equity REIT, right?
yes, an equity REIT.
You can value it as the sum of its parts, but then you're not valuing it as what it's done. So you can value each one as that's really not it's not a discounted cash flow valuation.
Right.
It's a liquidation.
So if I value it as it were any other company using everything that we've been talking about, should that theoretically work?
An investment, yeah. It would be a dividend discount model. It would be based on the dividends that they pay, and you have to estimate what those potential dividends will be given the constraints of right? They have to pay at least 95% of these dividends. So it will be a dividend discount model with you checking to make sure the dividends are in fact affordable.
Right. So you have to, you'll just build in the constraints.
Exactly.
Right. Okay. I get it.
Yes.
I'm Jim. I'm from the Advocacy Society. Yep. I just wanted to confirm November 3rd. You're still good to talk about interest rates with Professor P.
Yeah.
Do you want me to set anything up between the two of you, or you know each other? All right. Great. Thank you.
Okay. It's 260?
Yes.
Okay, folks, let's get started. Okay, so today we're going to tie up those last few loose ends. I mean, I'm going to talk about complexity. I'm going to talk about what to do about debt that you subtract out. We've talked about what to do about debt to put into your cost of capital, what to do about debt to subtract out. And then I'm going to close off by looking at what to do with the fact that so many companies are now paying their employees with equity, options, restricted stock, what to do about those. And then in the last part of the class, which will be the bulk of this class, I want to return to a theme I introduced in the starting class. And this is something I want you to think about while you're doing your discounted cash flow valuations, which is every valuation tells a story. Whether you like it or not, when you send me an Excel spreadsheet, you're telling me a story about your company. And when I repeat that story back to you and you're surprised by your own story, you know what that tells me, right? You've been doing a lot of financial modeling. It's an Excel spreadsheet. There is no story. So that's partly what I want to focus on, is kind of getting that story together. But without that story, your valuation will be just a collection of numbers. And more importantly, you will have no faith in your own numbers. You know why? Because you know how much you can move them by just changing the numbers. So let's do this, the start of the class test based on those last few loose ends. I mean, one of the central themes in valuing a business is you do the discounted cash flow valuation of a business, and once you value the business, you add cash, you subtract that debt, you get to the value of equity. Let's go back and revisit that theme about a specific detail. Let's suppose you've done a discounted cash flow valuation of a company and arrived at a value of 100 million for the operating assets. That's free cash flow to the firm, discounted the cost of capital. Let's assume this firm has no cash, and that it has 80 million. It has debt outstanding, but the debt has a face value of 100 million. So that's what you actually owe, and a market value of 80 million. How can the market value of debt be low? When you see the market value of debt be lower than the face value, what are the things that cause that? There's only one thing, right? Which is the interest rate on the debt is much higher than the coupon rate at which you borrowed it. And what causes that to happen? Either the market interest rates have gone up, which is unlikely, especially in the US, because debt is usually callable and you're going to replace it, or you've become much riskier, right? So basically, when we talk about high yield debt or risky distressed firms, that's what you would see. So I have a very simple question. I've given you the value of the firm. I've given you two values for the debt. One is a book value of 100 million. The other is a market value of 80 million. And I want you to tell me, I'm sorry, did I get the answer is obviously wrong, so you'll have to come up with the right answer. Okay? I want you to tell me what the value of equity in this company is. Okay? So here are the choices. You can tell me it's worth nothing. Why? Because 100 million in value is equal to the, you can tell me it's worth 20 million. So knock off the last zero in that 200 million, 20 million, which would be the 100 minus 80. Or maybe it'll be some number between 0 and 20 million. Okay, everybody ready? How many think it's worth nothing? Nobody? Really? Okay. How many think it's worth 20 million? The rest of you have no idea where to go, right? You don't care, one or the other. Okay? Actually, if you open up any finance textbook or any valuation book, the answer will be 20 million. You're supposed to subtract out the market value of debt, but we're going to come back and I'm uncomfortable with that, and here's why. As a going concern, that's actually right. The value of the firm is 100 million. The value of the debt, remember the way I got the 80 million is I'm not assuming you're going to default on the debt. I actually take your promised payments and I discount them back at a much higher rate. So implicit there is the assumption that you will manage to pay off the debt. As a going concern, the value of the equity is 20 million. The reason that makes me uncomfortable, let's suppose that a big safe company now decides to acquire this company. So the value, let's say the value of the business is still 100 million, right? Cash flow to the firm discounted back at the cost of capital. The minute that acquisition announcement is made though, what's going to happen to the market value of the debt? It's going to go back up to 100 million, partly because now a safe company is going to back it up. So almost instantaneously the 20 million would disappear if somebody with less, that's what makes it an unpleasant place to be, is to stay at the 20 million. So technically, you can say the value of equity is 20 million, but don't get too stuck on that number because it's going to be very sensitive to who the debt is issued to and how much default risk there is in the debt. So we'll come back and talk about what to do. There is no easy answer, as you can see, but it's something that we take for granted, especially when we value equity in distressed companies. We're also going to talk about equity compensation. Okay? So to set it up, let me give you a very simplistic example. Let's suppose you value the equity in a company at $1 billion. So you've done the discounted cash flow valuation, you subtract out debt, you add cash, you come up with $1 billion. There are 100 million shares outstanding. The value per share is going to be, this is not a trick question, billion divided by 100 is $10 per share. So up till there, everything looks okay. Now I say, you know what? This company is now going to grant 10 million options to its CEO, and the strike price on those options is also going to be $10. So my question is a very simple one. The value per share, before I told you this was $10 per share, right? I'm now issuing 10 million at the money options, technically. What should happen to the value of equity in this company? And I'll give you some choices and I'll tell you where these choices come from. The first is, I can say the value of equity is $9.09. You know how I got there? I took the billion and I divided by 110 million shares. That's called the fully diluted approach. We adjust the number of shares for options outstanding. That's one choice. The second is, I can say, look, these options are worth nothing. Why? Because they're at the money. So if today they were exercised, it cost you nothing. So the value per share stays at $10. Here again, the choice could be, it could be between 909 and 10, or maybe you think it's going to be less than 9 or greater than 10. So basically, I've covered the spectrum here. Each of these is offered in the real world. A lot of analysts, when they deal with options, the way they deal with them is to do what I did first. Adjust the number of shares for options outstanding, use the larger number of shares. What's wrong with doing that? What am I missing when I do that? Of adjusting the number of shares for options? When those options get exercised, which is what I'm assuming here, what's going to happen? Options are at a strike price, right? To exercise the option, what has to happen? The managers have to pay you $10 for the option to be exercised. Those $10 will come into the company. I'm ignoring the cash. So even if I'm saying, look, these options are all going to be exercised right away, I have a problem, which is if they get exercised, cash will come into the firm and I'm not counting in the cash. So the fully diluted approach misses the cash inflow, so it's going to understate the value per share for companies. What's wrong with the second answer where I said they're worthless because they're at the money? Are options worthless if they're at the money? I mean, try going on the CBOE, buying at the money options and refusing to pay for them. so they're at the money. Only in accounting was this considered true for a long time. Until 2007, this is what the accounting rules in the US implicitly and explicitly assumed, is if you grant options at the money, you're giving away nothing. Really, you're giving away nothing. And companies took that to heart, and they said 1,000,000 times nothing is nothing, 1,000,000,000 times nothing is nothing. They gave away a lot of nothing until they discovered that they'd given away something, in fact, a lot of things. The problem with the second approach is options have value. They have a time value. And that time value will mean that even if an option is at the money, you're giving away something of value when you give them. So whether you like it or not, the answer is going to be that it's going to, your value per share will have to go down because I've given away a share of the equity, not to 909, but to some number between 909 and 10. How much it will drop will depend on what? How risky the company is, because ultimately the option value is a function of the risk of the company. And the riskier the company, the more value you've given away. And the kinds of companies that grant options tend to be the riskiest companies in the world. So not surprisingly, when options get granted, your value per equity goes down. So we'll come back and address both of those in the different ways of dealing with options. But let me start off by going to this. To slide 228. Okay? So I'm going to again make you think about making a choice as an investor. So don't think like in valuation terms, don't think in numbers terms, think in terms of making a choice. I come to you with two companies. The two companies have exactly the same numbers in terms of operating income, cash flows, growth, and cost of capital. We kind of looked at this at the start of the class. The first company is in a single business, the second company is in multiple businesses. The first company has a very simple holding structure. So you can see exactly what they own, it's on the balance sheet. The second company has cross holdings, special purpose entities, all kinds of messes. The first company has transparent accounting, where the financials tell you what's going on. The second company, as we talked about last session, has opaque accounting. So the first company is simple, the second company is opaque. And I asked you to make this choice, and I think we talked about this and we said, if you're an investor, you'd rather go with the simple company than the complex one, because what you don't know could potentially hurt you, because managers hold back bad news. And I also made a confession that in all the books that I wrote through early 2002, I never even thought about this. It came to the surface when Tyco got into a problem in the early part of the last decade. If you've never heard of Tyco, it's a company that grew through a lot of acquisitions, was a conglomerate, was a very successful company until it had an accounting scandal that blew up. And when the accounting scandal blew up, the company lost 70% of its stock price. That was no surprise, but when Tyco went through the accounting scandal, GE lost 15% of its value. Saying, what do they have in common? What do Tyco and GE have in common? They're both conglomerates, they both grew through acquisitions. You see what the market is doing? It's saying, look, we were fooled by Tyco because it grew through acquisitions and was in multiple businesses. How do we know GE is not fooling us as well? It sounds incredibly unfair. But that's what markets do, is when one company holds back information, they look for other companies like it and they punish them all. It's a collective punishment. This was actually in the midst of a valuation class. This was in 2002. And we brought this up and we said, no, we should do better with this. At least I tried to say I should do better. And to do better basically means we've got to find a way to bring complexity into value. It's not showing up right now in the cash flows and the discount rate and the cost of capital. We have to find a way to punish complex companies like Tyco and GE. So the session right after, I came back with to bring in complexity into valuation, there are two questions I need to answer. First is I need to measure complexity. What is complexity? And the second is I need to convert that complexity measure into an effect on value. So the next session, I came back with my first attempt to measure complexity. And I'll make a confession. When I showed this to the class, they were not impressed. Here was my first attempt to measure complexity. I counted the number of pages in the 10Q and the 10K. I know it's incredibly simplistic, but if you were going to avoid one company in this list, which company do you least want to value? What the heck is one? That's not War and Peace. That's how many pages it took them to tell me what happened in 1 year. It takes you 1,026 pages to tell me what happened in 1 year. You're one heck of a screwed up company. So I showed this in class and people say, well, we're not paying $150,000 to count pages. And I said, you're right. I'll come back next session with something more sophisticated. So the next session I came back with what I called my valuation shit list. These are all the things that bug me when I'm valuing a company and how much they bug me. It's a personal shit list created after years of grappling and wrestling with companies and getting frustrated. So here are some of the things that bug me. A company that tells me they're geographically diversified but doesn't tell me where. What the heck does that even mean? Or it tells me where and I cannot recognize any of the regions of the world. You've noticed in some of your companies, they break down their revenues. They say, where the hell is that? The lost continent of Atlantis. I mean, there are all kinds of places. I've never heard of that. Companies whose effective tax rates go from plus 38% to 211% to minus 55%. Numbers are all over the place. So I made a list of everything that bugs me when I value a company and how much it bugs me, and I created a spreadsheet. So the higher the score you get on the spreadsheet, the more complex you are as a company. So I showed this to the class and I said, do you like this more? They said, yes, this is exactly the kind of thing we want. And I said, there's one small cost, or big cost. To get the score for Citigroup, what do I need to do? Read 1,026 pages. I said, I know why I'm doing that, but each of you is valuing a company this semester, right? And they could see the train coming at them right down the tracks. And there's nothing they can do at this stage to get out. And I said, this semester, in addition to doing your DCF valuation, your relative valuation, give me your recommendation, why don't you come up with a complexity score for your company? They bitched and they moaned, but what choice do they have? They should have stuck with the count the pages in the 10K that I suggested up front. So that was the only semester I added this to the project. I required, don't worry, I'm not going to ask you to do this, to come up with a complexity score. If you want to, try it out. It's actually very interesting to see where your company falls. And it was interesting because there were about 250 people in the class that semester. And here's what they found. On average, they found that companies that grew through acquisitions were about 35% more complex than companies that grew with internal investments. It's much more difficult to value a company that grows through acquisitions simply because there are so many things that are hidden from you. Second, they found that emerging market companies were about 25% more complex than developed market companies, primarily because of their holding structures, cross holdings, family group companies. But here was the irony. Out of the 250 companies that semester, the most transparent company or the least complex company in the entire class was an Indian company. It's a company called Infosys. Surprising, right? You're saying emerging market company. The reason I bring that up is often when I talk about this in emerging markets, you know what the defense that CFOs offer in these markets is for complexity? We can't help it. We're Indonesian companies. The information disclosure laws here are not that strong. As if information disclosure laws put a ceiling on what you can reveal rather than a floor. Nothing stops a company from being transparent. So when companies hide behind complexity, they're not telling you, look, we choose to be complex. The most complex company out of the 250 was GE. It's a company that grows through acquisitions, is in multiple businesses, and here's, I think, what capped the crown, what created the most complex company. Any company with a financing arm embedded in it automatically becomes a much more difficult company to value. If any of you have companies, you know what I mean by financing arm? GE Capital, Ford Capital, GM, GMAC, you're saying, what, so what? Because what you have is a bank embedded in the middle of a regular company. The company says, look, we've built a wall around the bank. All the debt is in the bank. How do I know? So when you have a financing arm, you essentially have a company that becomes more difficult to value. GE was the most complex company of the entire group. Some of you, as you sit down to value a company, will notice that your company is a lot more complex. Financial service companies are automatically more complex than any other company simply because they're opaque. It's difficult to observe the quality of their assets. For a long time, we made a Faustian bargain. We said that's okay because you're regulated. The regulatory authorities will make sure you're not doing something incredibly stupid. And you're marked to market. So the accountants will tell us what your assets are worth. But 2008 dispelled both those delusions. So now we're in this gray zone with financial service companies where we still have opaque financials, but we have no trust left in these companies. So guess how it manifests itself? The typical bank trades at less than book value. Why? Because you no longer trust. So for those of you valuing financial service companies, you're going to grapple with this. Don't expect easy answers. It's not your fault. It's the reality that we face right now. And we still have to try to value these companies. You can't be paralyzed, but that's something to factor in. So measuring complexity, you can either go simple, count the number. And it's actually, the 10K thing is a surprisingly simple test. So because this is in fact earnings season, as the 10Qs come out, just download the 10Qs, see how many pages it runs. Surprisingly simple measure of, is this a simple company to value or a complex company? Now comes the last step. You've measured complexity. You've got to bring it into the valuation. You have to find a place. Yes?
So say a widget company is focused...
Let's not use widget companies. Let's use a real company. I hate widgets.
Okay,
Yeah.
GE, say, or...
Make it simpler. GE is in 26 businesses, right?
Yeah. Lending Club.
Lending Club, okay.
I want to do a non-finance company.
Oh, you want to do a non-finance company. How about Netflix?
Yeah,
Let's pick Netflix. We all kind of get Netflix. We have Netflix. We pay for Netflix, so might as well value Netflix, okay?
If Netflix's book is valued as mark-to-market, so their accountant's market-to-market, should it ever be trading higher than book value assuming the market?
Okay, that's actually a very good question. Let's suppose fair value accounting comes into play. Fair value accounting's end game is what? Ultimately, they want to mark-to-market every company's assets, not just financial. What is marking-to-market in accounting required to do? Does anybody? Are there any accountants here? Should be a few. Don't want to admit to it because you're afraid I'll jump down your throat. Okay? But what is mark-to-market in accounting required to do? What is fair value accounting? There's this thing called FAS 157, which actually lays out the principles of fair value accounting. You know what fair value accounting requires you to do? Come up with a number for your asset that a willing market participant will pay for that asset in today's market. You think, so what? Remember we drew the contrast between value and price? What's value? Value comes from cash flows, growth, and risk. What's price? It's what people are paying in the market today. Fair value accounting is really fair price accounting. So even if you mark to market, what are you marking it to? You're marking it to the price. So even if they do everything right, what they're trying to do is say, what will somebody price this asset at? So you're not getting a value from the balance sheet. And you're also just fair pricing existing assets. You're not pricing growth assets. So investments you haven't made, like Netflix's future growth, can't be priced. So basically it's not going to show up. So even in that end game where fair value accounting does exactly what it was meant to do, it's not going to substitute for what the price of the company is or the value of the company is. Which raises the interesting question, why are we doing it? I have no idea. It's one of the biggest wastes of time I can think of. But for whatever reason, accounting wants to be relevant again, and this has become their way of bringing back relevance. So now comes the question of, now that you've measured complexity, how do you bring it into evaluation? Here are your choices. If you're the kind of person who says, it doesn't bother me, then you don't care, right? The value is unaffected. And that's in fact the attitude we took pre-2000. Pre-2000, we made the assumption of, hey, complex, simple, it doesn't matter. It's those accounting scandals that wake you up and say, hey, maybe you should care. And right after those scandals came about, you went to the other extreme, which is if I can't see it, I can't value it. So complex companies, I'm essentially going to act like all that complex stuff that I can't see, I'm going to assume has a value of 0. But I'd like a midway compromise. And here are the places I can go in a discounted cash flow valuation. Maybe I can haircut the cash flows of complex companies. You know what haircutting the cash flows means? Basically, I take my expected cash flows that I have for the company and say, this is a complex company. I'll reduce those cash flows by 3, 5, 7, 10%. The problem, though, is why 3, 5, 7, or 10? Completely arbitrary. The second and more promising approach is maybe adjust the cost to capital for complex companies. Remember I said I spend a month of my sabbatical on each topic, and I spend a month on complexity. And one of the things I did during the month was I computed, remember how I did the implied cost of equity for the S&P 500? I actually did 2 implied costs of equity for the S&P 500. I broke the S&P 500 into complex S&P 500 companies and simple S&P 500 companies. Incidentally, there is no correlation between company size and complexity. The 250 companies that were, you can have large companies that are simple. Walmart is an incredibly simple company to understand because you know exactly what they do and everything's right there. GE, of course, is an incredibly complex company. So I broke the S&P 500 into simple S&P 500 and complex S&P 500. Then I did an implied cost of equity for each group. You see what I was trying to estimate? I was trying to figure out, is the market demanding a higher premium for complex companies? Maybe it was a tenor of the times. In 2006, complex companies had a cost of capital about 1% higher than simple companies. You're saying, what are you going to do with that? If I'm valuing a complex company and I'm using a traditional equation, I might add that 1% onto that cost of capital, saying you're a complex company and lower value. But I'll give you my preferred way of dealing with complexity. When you value a company, and each of you is going to face that, you'll be looking at the existing numbers. So let's say you have a company that's doing really well right now. It's earning well above its cost of capital. It's earning excess returns, which is a requirement to create value from growth. If you understand what the company does, then you can say, okay, I can assume that this will continue for the next 5, the next 10 years. So if you're valuing Amgen, and you say, look, they're earning well above the cost of capital, it's coming about because they have a strong patent protection, then assuming it'll last for 10 years is reasonable. But let's say you value a company, it's earning a high return on capital relative to the cost of capital, but you have no idea what it does. You're in a bad place, right? You can see they're making more than the cost of capital, but you can't see why. That's the definition of complexity. You don't understand the company because they're not letting you close enough. Then you should be a little more cautious about assuming they can earn more than that cost of capital in the future. The fact that they earned more last year is good, but making that assumption about sustainability becomes more difficult. You know what that's going to do? The value of your company is going to decrease if you assume that your excess returns are going to go to zero much faster. If you don't understand a company, maybe that's the best choice, is lower those excess returns towards zero much more quickly. I'll close off with one final thing that I found when I looked across the S&P 500. Now, if you look at multiples like price earnings or price to book or price to sales, there are variables that drive that multiple. We'll come back and talk more specifically about what those variables are. But if you ask me to explain differences in price to book across companies, the variables that I would use are return on equity, beta, and growth. Those are the fundamentals that drive price to book companies. So I took the S&P 500, I took the 100 largest market cap companies. I took the price to book of each company. I took those three variables, the traditional variables, and then I threw in the number of pages in the 10K into the regression. So the results were pretty predictable. Return for the first three variables. As return equity increased, price to book went up. Higher return equity companies had higher price to book. As beta went up, price to book went down. Riskier companies had lower price to book. As growth went up, price to book went up. High growth companies at higher price to book. And then I threw in the number of pages in the 10K. Somebody tell me what this minus 0.003 tells me about complexity. Every 100 additional pages in your 10K does what to your price to book ratio? Lowers your price to book by about 0.3. What's Citi's price to book right now? Probably 0.8, 0.9. I have a very simple proposal for doubling the price to book ratio. Knock off 300 pages from your 10K. Sounds facetious, but what are we asking Citi to do? Simplify, focus. It's a lesson I think financial service companies need to take to heart because I think complexity has essentially crippled them in the marketplace. Jamie Dimon will not listen to me, but I think JP Morgan would be better off as a bunch of companies rather than one big monstrous company where nobody has any idea what's going on. In fact, if I were a bank, I'd take the Volcker rule and I'd run with it. I'd be the first bank out there acting like I'm doing it for other people. We're adopted the Volcker rule, no more proprietary trading. We're going to have a commercial bank, we're going to have an investment bank, we're going to hedge fund, we're going to let them all trade individually. I think in this marketplace, you would actually get a higher value for most banks if you had them trading as individual pieces. It won't happen because that means letting go of an empire you've essentially built over 20 years. But I think we're paying an immense price for complexity, at least in the financial service business. Any questions on complexity? So let's talk about debt. There are two different rules I'm going to suggest for debt, depending on where you encounter it. When you get to the first place you run into debt is when you do cost to capital, right? You need a total debt to the debt to equity ratios, debt to cap ratios. When you're looking at cost to capital, your definition of debt should be narrow. Narrow in what sense? The only debt I will include for debt in the cost of capital is interest-bearing debt, short-term or long-term, bank loans and corporate bonds, and lease commitments. That's it. I'm not going to bring in underfunded pension obligations, underfunded healthcare. All those other things I see as liabilities on the balance sheet will not be debt when I do debt for cost of capital. That's the first place you run into debt. You come up with the cost of capital, you discount the cash flows of that cost of capital, you come up with the value for the firm, right? Now you run into debt again, a debt you subtract out. Here, the definition of debt has to shift. And that's why I gave you the start of the class test. Which will you go with, the market value or the book value? Every textbook will say market value. The caveat I would add is, use market value for your valuation, but if the bulk of your equity value is coming about because your market value of debt is lower than the book value, be very careful about buying those shares, because that share price could very quickly start to dissipate if the debt starts to rise back up towards the book value. So there's no simple rule I can give you as to what to do with debt, but be open to the possibility if somebody uses market value of debt to do cost of capital, that switching to book value of debt when you do equity is not a big crime. In fact, it might be viable, especially if you're worried that this company might potentially be taken over by somebody else. Okay? So that's the first place you'll encounter. If you're doing a liquidation value, it's no contest. There you have to use book value, because when you liquidate the company, your bank is not going to say, just pay me 75% of what you owe me. So there it always has to be book value. So with discounted cash flow valuation, you can use market value, but do it gingerly. In liquidation value, it should always be book value of debt that you subtract out. But here's the other difference. When you get to this stage where you're subtracting out debt, your definition of debt gets broader. In what sense? If you have an underfunded pension obligation, think about it as an equity investor. It's a burden on you, right? I did not show it as debt for cost of capital, but it's something you have to worry about as an equity investor, because you have to come up with that underfunding. So even though you did not include underfunded pension obligations and healthcare obligations as debt when you did cost of capital, there's no harm including it when you do debt for the value of equity. And here's the other thing you have to worry about. Let's say you're valuing equity in Volkswagen or Valiant or Deutsche Bank. You do the traditional valuation, you come up with the value for equity. You know what you're worried about? All these fines and legal fees and lawsuits wending their way towards you. This is your last chance to mop up those loose ends. Even if the accountant hasn't set aside a provision to cover that, you and I as equity investors have to start thinking about how much will it cost. So if you have a lawsuit against you that you think you might lose, you might want to consider the expected value of what you will have to pay out and subtract it to come up with the value of equity. About 5 years ago, a couple of students from the law school came over to my office, and they're in the last year of law school. They come in and they say, we don't want to be lawyers. So why are you telling me? Go tell the dean of your law school. I have nothing to do with this. They said, we want to be in investing, and we want to talk about how we can create a niche. And so, can we learn some Excel spreadsheets? I said, it's too late for that, right? I mean, what's the point of learning spreadsheets and trying to catch up with somebody who's been doing spreadsheets for 20 years? I suggested that they set up a niche business. I said, why don't you hang up a shingle, lawsuits are us, or whatever you want to call it, and you focus on companies that are targeted in lawsuits. And that's a lot of companies in the US. And this is all you do. Forget about doing free cash flow to the firm, cost of capital. Let other people do that. Your focus is going to be on the likelihood that you will lose this lawsuit as a company and what the expected payout will be. Because that's an incredibly messy thing for investors to deal with. Investors, I think, screwed up big time. In fact, when Merck was in the midst of its Vioxx lawsuits, every time Merck would win a lawsuit, the stock price would jump 7%. Every time they lost a lawsuit, it would drop 5%, even though these wins and losses were kind of intermediate steps because everything got appealed. So if you have lawsuits hanging over the company, you have to at least think about what the consequences will be and try your best to bring it into the value of equity. If you've been valuing tobacco companies for the last 25 years, this has been your big X factor, right? You can do everything right, and last part of the process, you got to say, how much of my value of equity will get eaten up? Because, so if you, and right now there are other sectors that are coming in which will fit the same problem, potential targets for lawsuits affecting the value of equity. So let me review. If you're doing debt for the cost of capital, keep your definition narrow. Interest-bearing debt and lease commitments. To subtract our debt to get to value of equity, you can redefine debt to be much more expensive. Which brings me to the last loose end, which is the fact that increasingly across the world, not just in the US, employees are being paid with equity. And this is going to be a factor for you, right? When you get, it used to be that it was just investment banks, you got bonuses on your salary. Now if your potential employer is, Amazon or Snapchat, a big chunk of your compensation is going to take the form of equity, restricted stock. Let's first set that on the table. Why do companies use equity for compensation? What are the two reasons? One is to align interests, right? Which is a fake reason. They couldn't care less about aligning interests. The other is they don't have the cash. Once you see that, the way to deal with equity compensation becomes much simpler. The reason they can't pay with cash is they just don't have it. So there's nothing wrong with giving equity to your employees because you don't have the cash. The question is, how does this affect valuation? I'm going to start with equity options, which are the messier way of paying, because there are two ways you can pay equity, give equity to employees. One is with options, which used to be the standard until 2007. But post 2007, companies have shifted away from options to restricted stock. And what's a restriction in restricted stock? I mean, obviously, when it says restricted, there must be some restriction. What's a restriction? First restriction is, do you get it right away? You have to stay a certain period. There's a vesting period before. And even after the vesting period, you know what the second restriction is? You can't sell the stock. So there's a liquidity restriction and a ownership restriction. But let's start with options because it's a messier thing. So there are two questions I want to look at. First is, how do options that you've already granted or restricted shares you've already granted, remember you've been doing this for a while, that a company's already granted affect the value of equity today? I call that the deadweight cost of past option grants and past restricted stock grants. And the second is, if your company's not done, if they're going to continue to do this, how do you deal with expected future option issues? And you can see the two questions have to be answered separately because some companies have a lot of deadweight costs and have stopped issuing options. Others might not have very much in deadweight costs and have a lot of options in the future, and you have to separate the two because one doesn't always lead to the other. So let's start with that first question. Okay? Let's start with the easier one. Let's start with restricted stock. Restricted stock, if it's already been granted, you don't have to worry about it. It's already part of your shares. Count those as number of shares, move on. Because restricted shares are just like regular shares, have that liquidity constraint. So with restricted stock, what you have to do in valuation is almost nothing. It's in your shares and you can deal with it. It's options that are going to be the problem in terms of existing options. In terms of expected future restricted stock grants, treat them like what they are, which is their compensation. Compensation is an expense. Expenses reduce your income. So if I expect you to keep granting restricted stock, I'm going to have less income in the future, which lowers my future income and my future cash flows and lowers value. So past restricted stock issues are already in your number of shares, nothing to do about them. Expected future restricted stock issues will show up as an expense item, lowering income and cash flows. Now let's turn to options. Options give employees the right to buy stock, right? By itself that means very little, but the right to buy stock comes at a specific price. The price is set up front, it's a strike price. If the actual stock price remains below that strike price, the options expire worthless. If it rises above, then your employees can exercise the options at a discounted price, and you as equity investors are paying for that discount. That's what makes options messy. Is even if they're granted at par today, they don't stay at par. They could become out of the money or in the money. And your job is assessing the value of options and taking it out of your equity value because effectively your company has given away that equity to employees at the time of the grant. So we'll go through the three ways of dealing with options using a very simple example. So let's say that a company has $100 million in free cash flow to the firm, cost to capital of 8%, 100 million shares outstanding, and $1 billion in debt. So let's do some very simple valuation. 100 million cash flows, 8% minus 3%, so $2 billion in value for the firm, subtract out the billion in debt, $1 billion in equity divided by 100 gives me a value per share of $10. So that's a traditional DCF valuation. This company gives 10 million options at the strike price of 10. In fact, this is the answer that the start of the class test. So now the number of shares potentially could go up to 110. Reason I say potentially is the options have just been granted. They could become out of the money, they could become in the money. We don't know at the time of the grant. So let's go through the three ways in which people have dealt with options. I'll give you my preferences, but you can look at all three and make your own choice. Here's the first. As an analyst, you say, look, there are 100 million shares outstanding, 10 million options have been granted, they could become shares. I want to be conservative, so I'm going to count all the potential shares. That's a fully diluted share count. So basically, I increase the share count from 100 to 110 million. I divide the billion in equity by the 110 million and come up with the value of $9.09 per share. And as I mentioned at the start of the class, the problem with that approach is you're ignoring that when those 10 million options get granted, you have to pay $10 per share. You're ignoring the 100 million that comes in. So you know what the second stage in this evolution was? When people realized they were ignoring that, what did they do to adjust for it? They took the billion, added the 100 million you would get, and if you do that, you come up with what's called the treasury stock approach, where what you find is not surprising. If you exercise the options today at the money, the value per share remains unchanged. The problem with this approach is you're acting like there's no time premium on the option, that at the money option is worth nothing. So in this approach, you're going to overvalue the shares. So with the diluted stock approach, you'll undervalue the shares because you're ignoring everything that happens at exercise. With the treasury stock approach, you're going to overvalue the shares because you're acting like the options have no option value. So you can already see what the third approach is going to do, which is we know that these are at the money options. We know the life of the option. If I can somehow value those options, and I should be able to, here's all I need to do. I'll take the value of the option, subtract it from my $1 billion equity value, and then divide by what? The original number of shares. I can't divide by the 110. That'll be double counting. So essentially, I deal with the options by valuing the options and subtracting from the value of equity. Do we know how to value options? For 30 years we have, right? With the Black-Scholes model, the binomial model. What type of options were they meant to value? When you use the Black-Scholes, the binomial, what are the original options they were designed to value? CBOE options, which were very short-term options on listed stock, right? IBM call options, IBM put options. You're saying, so what? Employee options have a couple of problems that make them messy. The first is that these options, instead of being 3-month options, are often 5 or 10-year options, much more long-term. That's the first problem. The second is, when those options get exercised, unlike a CBOE option, you can actually affect the share count, and by affecting the share count, actually affect the underlying stock. So when you and I go out and exercise options in the CBOE, we can't affect the stock price in IBM by exercising options. But when you exercise employee options, you could potentially affect the stock price. That's the second problem. The third is, in the option market, if I buy a call option on a stock and the stock goes up, 99.9 times out of 100, rather than exercise the option, what am I going to do? I'm going to sell the option to somebody else because there's an option premium. But the problem with employee options is they're not liquid. You see why this might affect the value? Let's say you have employee options in a stock like Netflix. Your exercise price is $70. Last week when Netflix announced its earnings report, the stock jumped to 117. You're feeling good, right? But 80% of your wealth is in Netflix options. You've been working in Netflix all your life. You're terrified of what? That the price might drop back down. You have 8 years left on the option. You see what might happen with employee options that you will not see with regular options? If you're really terrified that the stock price is going to drop and I don't let you sell the options, what are you going to do? You're going to exercise the options before expiration and give up the time premium because you're worried that if you wait, that 117 could go back to 65 or 45. Employee options get exercised before maturity, unlike traditional listed options. In fact, empirically, employee options seem to last about half their stated life. So if I grant 10-year options, on average they get exercised halfway through because of the lack of liquidity. So options are long-term. the underlying stock price can be affected when I exercise. And finally, because of this illiquidity, they can be exercised early. You can see, so what? What type of options was the Black-Scholes designed to value? European options. What makes them European? It's unfortunate that we attach this geographical. What's European about them? You can exercise only on the expiration date. So when you use the Black-Scholes to value an option, you are effectively assuming that people will not exercise early. And with listed options, it's a very good assumption, right? Because they don't. But when you use a Black-Scholes model to value employee options using the stated maturity, you can see already what's going to happen. You're going to overvalue these options because you've used too long a maturity. So I'm going to use option pricing to value these options, but I'm going to adjust for a couple of things. The first is the stock price right now is $10, the strike price is $10. Let's play a little game. Let's say I tried to go out and exercise all these options today, all 10 million. I'm the CEO. You know what's going to happen to the stock price when I try to exercise these options? Stock price is actually going to drop in the process of trying to exercise. That's a dilution effect. So the first thing I'm going to do is I'm going to adjust the stock price for the fact that if I try to exercise these options today, my value per share will drop to $9.58, and that's going to reduce the value of the option. So rather than use the stated stock price, I'm going to use the dilution adjusted stock price. I actually considered taking the maturity of 10 years and making it 5. Why 5? Because empirically, options get exercised about halfway through their life. And I probably should have, but I left it at 10. And with those changes, the value that I get per call option granted is $5.42. So it's a Black-Scholes model with a dilution adjusted price and potentially a shorter maturity, which means the value that I'm going to get for employee options is less than the value that I will get for listed options. It's $5.42 an option. How many options did I give the CEO? 10 million. $5.42 times 10 million means I've given a $54.2 million share of my equity. The value of equity then that's left after that grant is $945.8 million. So I've subtracted the equity grant. You divide by the 100 million shares. So again, I want to re-emphasize, if you do this, don't count the options in your number of shares. That's double counting. The value per share that I will get after this option grant is $9.46. Lower than the 10 that I got with the treasury stock approach, and higher than the 9.09 that I got with the diluted stock approach. And that's why if you look at all of my valuation spreadsheets, I give you this chance of adjusting for employee options, right? And this is what I do. I take all of your options, and when you enter the maturity for the options, you can take the stated maturity that's in that 10K, but if you want to, reduce it by half. If you feel that these are employee options, you've got to be more conservative. And when you do that, what you get as the value of the equity options will be subtracted from your DCF value of equity before you divide by the number of shares. So existing option grants or options outstanding, you're taking out of the value of the equity because you're saying they've been given away, that's my equity gone, I'm going to reduce the value per share to reflect it. Any questions on employee options? There's a little bit of a circularity when I do the 958. To get the diluted stock approach, I've got to value the options and feed it back, which is one reason I have to check the iteration box when I do this, because without it, the option pricing model will start to break down, because I need the estimated value of the options to get the diluted value per share. One final point about options. For whatever reason, accounting shifted to dealing with options the right way in 2007. So right now, if you're a company and you grant options, you have to show those options as expenses using an option pricing model. That wasn't true before 2007. That's why companies actually shifted away to restricted stock, because the minute I started attaching a true cost to the option, they said, oh my God, we're giving away too much, as if that was starting just because of the accounting. The tax law, though, hasn't changed to reflect the accounting changes. Here's how you get taxed on options as a company. You grant the options. No, they're not shown as expenses. They're shown as nothing. So you don't get a tax deduction. When the options get exercised, you as a company get taxed on the difference between the stock price and the strike price. Which means rather than pay taxes when you're giving the options, you get taxed when the options get exercised. I don't know whether you remember when Facebook went public, Mark Zuckerberg had to pay $1 billion in taxes at the time of the IPO. In fact, he, I think, caused the California budget to go into surplus just that quarter by just paying his taxes. And part of the reason was he got a huge option grant that he converted to shares at the time of the IPO. He was required to as part of the IPO. And the minute he did that, he had to pay taxes on the income he got. Facebook had to pay taxes on the, or claim the expense at the time that. So in a sense, what you saw was one bunched up option expense or tax expense when the options get exercised. So all I'm saying in a long-winded way is when you grant options, just like when you pay compensation, you do get a tax deduction. And the way I reflect that when I do my valuations, remember that 54.8 million estimated the value of the options? If there's a tax saving I'm getting from that, all I have to do is multiply that by 1 minus the tax rate, and that becomes my option adjusted value of the equity options. But check the tax laws first to make sure you're not violating some simple rule, because that might vary across countries. Last step. Your company might not be done granting options. You can't stop right now. So you've dealt with the options in the past, but that's in the past. If your company is going to continue to grant options in the future, remember options are expenses, and expenses reduce your income. You're going to do the same thing you did with restricted stock. Estimate what those option grants will be in the future. It's just tough to do because you don't know how many options. So here's what I do. Look at how much the option grants were as a percentage of revenues last year. So let's say the last year there were 2% of revenues. You can assume one of three things. You can assume that those 2% will continue in perpetuity, which is what you might do for a company like Cisco, which is in a mature state. You don't expect it to change. If it's a high growth company, that percent will probably get smaller as the company gets bigger. So you might say it's right now 12%, but it's probably going to become 2%. So if you look at Twitter, for instance, that company grants options like it's nobody's business. And you know exactly why. The company has absolutely no money. And the only way they can hold on to employees at this stage is by granting mega option grants. When you're valuing Twitter, that then becomes an expense item you got to build in, which is going to bring down your income, bring down your cash flows. It looks like it's double counting. A lot of people say, aren't you double punishing this company by lowering the cash flows and reducing the value of equity? Not really, because I'm doing it for two separate reasons. I'm lowering the value of equity for past option grants. I need to do that. I'm lowering your net income and cash flows for future option grants, which I need to do that as well. And if you're doing both, you're doing it because you have two separate costs to bear as a company. I'll give you the contrast. When you value Amazon, there are still some options outstanding that will lower your value of equity. So that will affect the deadweight cost. But they stopped granting options about 4 years ago. So there are no future option issues to deal with. So your future cash flows are not affected. So think of those as two separate issues and answer the question separately. Options in the past, you reduce your value of equity today. Options in the future, you lower future income, future cash flows, and future value of equity. Any questions on restricted stock or options? And don't fall for all the dancing you hear about, no, these are non-cash expenses. That's absurd. I can't let you use the barter system to evade cash flows. So options are expenses like any other expenses. They reduce income, reduce cash flows, and reduce the value of equity today. Final point about options, as I said, options have the biggest impact on value when you're a high-risk company, more volatile the stock price. The kinds of companies that grant options are exactly the kind of companies you have to worry about options the most, because that option premium is going to be large. So if you're valuing a young startup, check for the options outstanding. Make your best judgment on what will happen to them over time, because that will affect your value just as much as options that are already on the ground. So last thing I want to talk about today is the importance of storytelling. And if you remember, I started this class by showing you this picture about how a good valuation was a bridge between story and numbers. That every number has a story attached to it, and every number has a, And I made a confession at the start of the class that I'm a natural number cruncher, that this does not come easily to me. So what I'd like to do is take you through the process of going from story to numbers, to make it more transparent. So when I sit down to value a company, this is what I try to do. And the reason I have to try to do it this way is my natural instinct when I want to sit down to value a company, whether it's Deutsche Bank or Twitter, is to go to a spreadsheet. And I have to fight that urge. So what I'm going to do is take you through the process of going from story to numbers. And it's a 5-step process. So the first step in developing a story to value a company is you got to understand the company. You got to understand the business. You got to understand the competition. You got to understand where it operates, why it does. So I'm going to use a company to kind of illustrate this process I go through. The company you've heard me talk about before, a company I've valued a few times over the last 3 years, it's Uber. I first heard of Uber in June of 2014. It's actually in the context of a Wall Street Journal story. I was reading it and said Uber had raised money from venture capitalists, and the venture capitalists had priced the company at $17 billion. And I make a confession, I didn't even know what Uber did. I would tell you that I'd never heard of Uber, but that would be a lie because I'd actually seen the word Uber on my credit card statements in the 3 months leading into June of 2014. Because it turned out that my second son was going to college in North Carolina, was using Uber and using my credit card. I don't know how that happened. But I thought he was taking German language classes, to be quite honest. And the lack of umlaut on the U should have, you know. But I looked at 17 billion for a German language class. That's the point the revelation hit me. This could not be a German language class company. They don't go for 17 billion. So I called him. It was 11:30 in the morning, too early for him to be awake. So I gave up on him, and I called my niece, who was in Chicago, because I said, no, what does Uber do? She said, it's a ride-sharing company. I said, what is a ride-sharing company? I had no idea what. It's like a car service. So how does it work? She said, I'm too busy. Why don't you find out for yourself? Download the app and do it yourself. Incredibly rude person. But I took it for whatever it was. I hung up the phone. She was busy. And I said, okay, let me download the app. And I downloaded the Uber app into my phone. And it was actually in my office. I hit the Uber app. And this neat little GPS shows me the car driving towards me with George at the wheel. This has never happened to me with a yellow cab. I said, this is neat. I can see the car coming. I can see George in the car. And the car pulls up in front of 44 West 4th Street. And I ran out to the car. I said, George, good to see you. He said, where do you want to go? I said, nowhere. Can you drive me around for about 45 minutes? I have some questions to ask you. He thought I was a serial killer for a moment. Then he took one look at me and said, I can take this guy, get into the car. So I got in the car, and for 45 minutes I asked him questions. I said, is this an Uber car? He said, no, it's my car. I said, do you work for Uber? He said, no, I'm an independent contractor. I said, why do you do this? I said, I need a second income. I work this regular job. I don't make enough money. This allows me to make money on something I already own. I said, what does Uber do for you? He said, they're like a matchmaker. They connect me with customers. I kind of got a sense of why he was driving for Uber. He dropped me off. I offered to pay him. He said, you don't have to pay me. I said, it's free. He said, no, you entered your credit card when you downloaded the app, right? Bells go off in my head. Yeah. He said, they charge you right away. And then I said, how do you get paid? And I still remember what he said. They send me 80% of whatever your charge is. I remember asking, why 80%? I said, I don't know. That's what they all do. I said, okay. And I got out of that car. I had a sense of why he drove for Uber. His second income. He already owned the car. He was paying the insurance at that time. He was using every single regulatory loophole to his advantage. I could see why Uber did it. Basically, for being matchmakers, what do? They collect 20% of your fee. The one missing piece was, why do people take Uber? So I called my son again, this time at a civilized hour, like 3:30 in the afternoon, and he was up. And I said, why are you taking Uber? He had a car at college already. So why do you need Uber if you already have a car? I acted like I knew what ride sharing was. So first I hit him with the guilt, how dare you be using my, why are you using my credit card to take Uber? And then I said, why would you want to take Uber? You already have your car. He said, Dad, on Friday nights and Saturday nights, I really like Uber. Now, there are some questions you don't want to probe too deep as a parent. I kind of let it go. But I kind of got exactly what he was saying. But this is a kid that I cannot even visualize taking a yellow cab. I can't even imagine him on the street waving his hand. No. So I said, what do you like about Uber? He said, I can call the car from the bar. I said, oh, that's good. That's pretty neat. You can call it. But you must pay a lot, right? And he said, no, it's cheaper than a cab. I said, you must wait a long time, right? He said, no, it's quicker than a cab. I said, these cars must be cesspools, filthy, right? He said, they're cleaner than a cab. I said, let me get this straight. You're getting a car that's quicker than a cab, cheaper than a cab, and cleaner than a cab. That's when I knew cab service was destined for doom. So basically, I could see why ride sharing was taking off, why customers liked it. So when I was done, I decided to draw a picture. I try to do this almost every company I value, trying so that I can understand what the company does. So I started off saying, why do drivers drive for Uber? Why do customers drive for Uber? What does Uber get out of this? How does Uber make money? That 80-20. And then I started thinking about, why can't everybody do this? If you're just a matchmaker, why can't I start a matchmaking service from my computer and allow people to connect? And the answer, at least in 2014, that I came up with for Uber, none of them were permanent advantages, but these were the three advantages. The first was, there is an advantage to being the first mover in this game, right? Because once you start to sign up the drivers and you have cars, it becomes more and more difficult for other people to enter the game. That was the first advantage. The second is, they'd raised $2 billion in cash. See why that's an advantage? I try to compete with somebody $2 billion in cash. They can underprice me till I'm pushed out of the market and then reprice it. And third, they were using technology to their advantage. You know, in what sense? I mean, this New Year's Eve, why don't you try this? Go to Times Square. Do what those crazy people do, hang out. At 1 o'clock, call an Uber to take you home. You will find an Uber, it'll take you home. Don't check the bill till the next morning. It won't be pleasant. You say $500 for 5 miles. You know why, right? Uber has surge pricing, and the way the surge pricing works is they adjust for demand and supply using the price. So at least in 2014, I had a sense of how Uber made money, why people took Uber, and why it was succeeding. I also had a sense of why they were able to grow so fast. You can see why, right? They don't own the cars, they don't hire the drivers. To add a new city to Uber is nothing, right? Add the city, then go looking for drivers. So it's a very low capital intensity business that can grow really fast because it doesn't make any investments in infrastructure. So when I talk about surveying the landscape, that's what we're talking about, understanding what your company does, the business it's in. And at least in the case of Uber, it's difficult because they were, in a sense, creating a new business, ride sharing. Second step in the process is I've got to convert what I've learned about the company into a story. Be careful though. This is business storytelling, not fiction storytelling. Don't make yourself into George R. Martin. I still remember about 10 years ago, my oldest son telling me, you got to read this guy, George R. Martin. Of course, Game of Thrones. Before the series, there was a book. First thing, I looked at the book and it was just daunting, like 1,500 pages. So I said, you know what, I'll try it out. 600 pages in, I had to call him and say, Ryan, I can't deal with this. I'm too old for this. Like hundreds of characters, I've lost track of them. They die, they come back to life, they move on empires. Too much stuff, I give up. You're telling a business story, don't make it Game of Thrones. Keep it simple, don't invent three-headed dogs, don't invent strange characters. Keep it focused on what? Every business, what's the end game? You got to show me a pathway to making money, right? No matter how creative your story is, you have to show me that pathway. So if you're Snapchat, you can talk about users and user intensity, but ultimately you got to say, this is the pathway I see for converting that to making money. So keep it simple, keep it focused. So here was my first try at telling a story for Uber. So June of 2014, the reason I put the date up is my story for Uber has evolved over time, and I'll tell you why it's evolved and how it's evolved. But in June of 2014, here was my story for Uber, and every part of the story is going to matter because it's going to come back into my valuation. I described Uber as an urban car service company. So let me take that apart. Urban. So where do I see Uber succeeding primarily? Cities and big towns. Car service companies. I'm already telling you what business I think Uber is going to be in. Urban car service company. That will expand the business, the car service business, by bringing in new users. Like whom? Like my son. Somebody would never have taken a traditional cab. So it's an urban car service company is going to increase the size of the car service market by bringing in new users. With local networking benefits. What does that mean? I'm not a fan of buzzwords, but networking benefits refers to the fact that usually when you get bigger as a company, it gets more difficult to get bigger. But if you have networking benefits, as you get bigger, it gets easier to get bigger. And with a ride-sharing company, you can see why that's going to be. In fact, on my phone, I always have the Uber app and the Lyft app, even though I don't take either service more than like 5 times a year. Whenever I land in a city, I hit the Uber app, and then I hit the Lyft app. You know what I'm checking for? I'm checking to see, first prices, I'm actually checking to see how far away a car is. And if I do that a dozen times in a city, I can tell you after the dozen times which service dominates that city and by how much. Why? Because if an Uber car is always 3 minutes away and a Lyft car is 15 minutes away, and I find this a dozen times in the city, that's telling me there are a lot more Uber cars than Lyft cars. That's a local networking benefit. As you get bigger, you start to dominate the market because it becomes more and more difficult for other people to come in. But the word local means that if they end up dominating New York, and I fly to Chicago, I don't care who the largest car service company in New York is, I care about the largest car service. So you can see what's going to happen in my story, right? In my story, Uber could end up dominating New York, Lyft could end up dominating Chicago, and Didi Chuxing could end up dominating Shanghai, and Grab Taxi, Kuala Lumpur. Local networking benefits. I'm going to assume that they'll maintain this completely arbitrary 80-20 mix. Why? Because nobody has an incentive to break that mix, right? So you want to kind of maintain it. That, in my story, they maintain that mix. And finally, they're going to continue with their existing capital intensity model, which is don't buy the cars, don't invest in infrastructure, the low capital. So urban car service company, which will bring in new users with local networking benefits, maintaining an 80-20 mix, and this low capital intensity model. That's going to be the story that you're going to see play out in my valuation. Before I get to that stage of converting into numbers, I've got to stop and ask the question whether this story is possible, whether it's plausible, or whether it's probable. Sounds like I'm playing on words, right? Any Jets fans here? Okay. They won yesterday, 2-5. So let me ask you a question. Is it possible that they could go 11-5? Possible, right? Possible is such a weak word. Is it plausible? Now it's getting a little tougher. Is it probable? Very unlikely, right? So possible is just, can it happen? Plausible is show me some evidence, and probable is put the facts in place. So I'm going to take my story through each stage. Is it possible? And the reason I care, if it's probable, it's easy to show in my cash flows. It's in the numbers. If it's plausible, maybe I can bring it into the growth and show it in value. If it's possible, I can wave my hands and perhaps bring in some real options to justify an additional premium on value. So I'll take you through the three tests because we've already talked about stories that are told that are impossible stories. And when I look at evaluations, that's one of the first things I'm going to check is, are you telling me an impossible story? And you're saying, no way, I wouldn't tell you impossible stories. I'll give you examples of impossible stories. Remember I talked about the Tesla 6 to 8% growth rate forever that Evercore assumed? That's an impossible story. Why? Because if you grow 6 to 8% forever, you're going to become the economy, and then what? That's an impossible story. You tell me that your company will increase market share. Okay, I can go with that. From 5 to 7 to 10 to 15, but if your market share exceeds 100%, in other words, the total revenues you have in year 10 exceed the total market you're going after, that's an impossible story. You tell me your company will grow profits by cutting costs. Possible. But you tell me it can grow forever by cutting costs. Impossible. Why? Because you can't cut costs below zero. Or here's a very technical impossible. You know how when you do cash flows, you start with net income or after-tax operating income, you add depreciation, you subtract capex, right? We do this in Excel spreadsheets all the time. Let's say that your depreciation right now is 100 million, your capex is 50 million. It can happen, right, in any particular year. And when you project it out, you let the depreciation grow at 3% a year, your capex grow at 3% a year. So 100 million depreciation grows. Again, so far it's possible. You can have a company that continues to harvest depreciation from past investments. You stop in year 5. Why? Because you're tired. You decide to do a terminal value using your year 5 cash flows. So what do you do then? You take the cash flow and you assume it'll grow at 3% forever. You've just crossed the line between possible and impossible. Why? Depreciation can exceed capex for the next year, the next 3 years, maybe even the next 5. It cannot do so forever. Why? Because you don't get to depreciate what you don't capex. Your depreciation cannot exceed capex forever. Impossible story. I'll give you some examples of implausible stories. You give me a company where you have 50% growth for the next 10 years. You know what the first thing I'm going to check is? I'm going to check your net capex and your working capital change. Why? Because I expect to see some reinvestment to sustain the growth. I see nothing. I'm going to email you and saying, I see a lot of growth, but where's the reinvestment? And maybe you have a really good story, like what? I'll give you an example. A few weeks ago, I got an email from somebody who took this class a few years ago, was valuing an NFL team. And he had projected growth of 5% a year for the next 10 years. And no, I mean, they own their own stadium, but there was no reinvestment going into the stadium. It's an old stadium. So I called him and I said, I can see your growth, I can see it's sustainable, but how come there's no reinvestment? How come you're not? He said, oh, there'll be reinvestment, but I'm not showing it. I said, why? I said, every time we have to upgrade the stadium, we go to the city and we threaten them. With what? We're moving to Las Vegas. Los Angeles is now taken, so you got to pick a big city without a football team. And say, if you don't do this, we will leave. Okay, I can get that. You've now made an implausible story into. So when I say a story is implausible, what I'm looking for is tell me a really good reason why the story holds. And if you do, I'm okay with it. But if you don't, then I'm going to push back and say maybe you need to put in reinvestment. You have a company where you see profits without any competition. High margins, no competition coming in. Again, I'm going to push back and say, how come? Earlier this year, I was in Dubai valuing a company called Al-Marai. Al-Marai is a Saudi Arabian food processing company with insanely high profit margins. So again, I remember asking, how come they have such great margins? And how come there's no competition? And the answer, of course, was the second largest, you print out the HDS page, the top 17 investors in Al-Marai. The second largest investor in Al-Marai is somebody bin Saud. The bin Saud, of course, tells you the part of the Saudi royal family. There's your competitive advantage. The competition is essentially kept out by edict. That effectively allows you. And again, I said, okay, I get it. That's why your margins are high. Implausible story, but I'm looking for a rationale. Or you have a company that makes high returns without any risk. Again, you need a protector, somebody who's keeping the competition out, or maybe you have a patent. What I'm looking for is give me a really good reason because this story sounds implausible. So these are the stories that don't quite sound right, but if you push back, maybe you can find the reason why they're okay. But most of the time, it's because you haven't thought through the consequences. And then you get to improbable. And that's a triangle we've kind of talked about. The three corners of the triangle are growth, reinvestment, and risk. And that's what I mean by when you send me your Excel spreadsheets, I'm not going to give you feedback on your growth rate being high or low. You know more about your company than you do. Here's what I'm checking for. I'm checking to see what you're estimating is growth for your company, what you're estimating is reinvestment for your company, and what you're estimating as risk. Because here's what I'd expect to see. If you have high growth, I expect to see usually high reinvestment, high risk. That's typical. Low growth, low reinvestment, low risk. High, high, high. Low, 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 I'm okay. You go high, low, low, high growth, low reinvestment, low risk. I'm looking for a reason, and I want you to tell me what the reason is. So when you turn in your spreadsheet, I want you to tell me, this is why I think my company can grow with low reinvestment. It's a toll road company. It's already built the toll roads. Now we're going to grow for the next 15 years. I get that. You have low reinvestment. So if I see a mismatch, that's when you're going to see the pushback, the comment saying, explain the mismatch either to yourself or to me, because that's what will allow this valuation to become a probable valuation. So that's effectively the test I ran, and that's, I think, a test where you're going to see a lot of stories start to break down. So I took the Uber story that I told and passed it through the test. The bulk of my story is it's an urban car service company, which is probable because you're already doing it, that will attract new customers. And I could back that up because I can show that with anecdotal evidence with my son, but there's actually a much more tangible evidence that I can offer you, which is what's happened in the Bay Area over the last 6 years. The Bay Area is where the ride-sharing companies came in first, and in the Bay Area, San Francisco, Oakland, and Marin, the urban car service market has tripled. Tripled in the sense, if you look at the taxi cab market in 2008 and the total car service market today, Lyft and Uber have expanded the market by tripling it. By doing what? By attracting people who would either have driven their own cars or have taken mass transit into the car service market. So that was plausible, so I felt pretty comfortable. There was a possible story floating around in 2014 that I did not bring into my valuation. And here's the possible story, and to back it up, let me tell you a little bit about my day so far. So I got up at about 6, I ran, I drank my coffee, so you're bored by already. At about 7:15, I got into my car. No, it's actually 7:30. I had to rush. I got to the train station, which is only 4 minutes away from my house, but I'm too lazy to walk. I parked the car, and I got on the 737, and I'll probably be here till about 4:30. And I'm going to get off the train when I get back at 5:30. I'm going to get back in my car and I'm going to drive home, park the car. That's another 4-minute drive back. And the car is going to stay in the garage, and I'm going to repeat this process every day for the rest of the week. So I drive about 8 minutes on a typical weekday. Weekends I go crazy. I sometimes drive 25 minutes a day. Collectively in a week, I drive about an hour and a half. And for this, I own a car, I pay insurance, I have maintenance. It's absurd, right? But if you lived in the suburbs, you really had no choice. So a few weeks ago, I'm on the train, I look out through the window, and this is actually a billboard that I've started to see in more and more stations, and here's what it says. Did you drive to the station today? And I can see myself nodding. It says, try Uber. You see where Uber is going? It's going after the second car market. It's in a sense saying, look, if you own a second car in the suburbs, you had no choice. You had to own the second car. But if Uber were ubiquitous enough that at 7:25, while I'm having my coffee, I could hit the Uber and I know it's going to be there in 5 minutes, why would I buy a car and pay insurance? That was the possible story. In 2014, I wasn't ready to go there. But today, when I'm valuing Uber, I would consider the fact that some of their growth is going to come from people who might have owned second cars who will no longer buy that second car and instead take a car service company to a transit station. I mean, I can see that already with my kids, that they're much more willing to say, I don't need a car, because if I'm in a city, I can use Uber whenever I need to go somewhere. It's actually starting to expand its potential market into that car sales market, and that could increase your sales. But in 2014, I wasn't willing to go there. Just to kind of give you an indication of the dangers you can face. I've talked about this before. But this is what I call the runaway story. You know, runaway stories, I've mentioned this before, a story that sounds so good you want it to be true. I mean, that's the only way I can explain what happened with Elizabeth Holmes and Theranos. For those of you who don't know the full story, Elizabeth Holmes was a 19-year-old dropout from Stanford. Who does that? You know how difficult it is to get into Stanford? This is like, you know, you got to be one of the 2% and you drop out at 19. And she starts a new business. You think, what's the big deal? People drop out of college all the time. First, most of the geeks who drop out tend to be male geeks, like Bill Gates drops out of Harvard or something. But this is unusual. A 19-year-old woman drops out, starts a business, not a tech business, but a blood testing business. And let's face it, this is a business we all absolutely hate. Right? Because we all had you've had interactions with that business, right? This is the way it works. You call a lab and you try to make an appointment. They say 6 a.m. 4 weeks from now. Why 6 a.m.? Could you give me something a little more civilized? Well, in 3 years, we have a 2 p.m. Okay, give me the 6 a.m. 4 weeks from now. You show up. They make you wait 2 hours. Why? Because they can. At 8 o'clock, the door opens. There's a nurse waiting. She looks like Nurse Ratched. She said, come on in. She has 2 buckets next to her. What's that for? Your blood. Why 2 buckets? Just in case Dracula shows up. They extract all your blood. You drag yourself out anemic out of the room. And then you wait. 2 weeks later, there's no news from the lab. You call and say, can I have my tests? No. You say, what do you mean no? Privacy loss. It's my blood. We'll tell your doctor. You can find out from your doctor. So you call your doctor. 6 a.m. 4 weeks from now. Okay, no choice. You go. You wait 2 hours. You come in. The doctor's looking at your results. So do you want to know your results? And you say yes. So maybe I will tell you, maybe I won't. And after keeping you on tenterhooks for about 20 minutes, you're okay. But don't relax too much because the final shock is coming. About 6 weeks after that, you get a bill in the mail for $1,500 for taking 2 buckets of your blood and finding nothing wrong with you. We've all gone through this indignity, right? So if somebody says, I'm going to find a way to disrupt this business, isn't yay, come on, I want you to succeed. And that's what Elizabeth Holmes offered. She offered a blood testing service with 2 drops of your blood, not 2 buckets, where the results would be known in 25 minutes and would be emailed to you. Imagine, emailed to you directly. Let's face it, you want the story to be true, right? In fact, you want the story to be true so much, you don't want to ask any questions that might make the story false. That's the only way I can explain how this company ended up with a $9 billion market, at estimated pricing by venture capitalists early last year. With some of the biggest VC names on that list, none of whom seem to have asked this question, does the blood test work? In fact, in October of last year, the Wall Street Journal reporter who decided to ask that question. In fact, the answers were in the public domain, because when you do blood tests, they're part of the FDA public. So you went in and checked to see how many of the 32 tests the Theranos claimed could be done with the blood actually worked, and you found that only one of the tests had been approved. The remaining 31 had been rejected because they were too noisy. And I'll leave you to decide whether you like noisy blood tests. And that kind of started the unraveling of the company. And if you've been reading the news, the game is playing out, right? First, Elizabeth Holmes, more stuff came out about the labs and stuff being hidden. So about 3 months ago, the FDA banned Elizabeth Holmes from ever being in the blood testing business. And a couple of weeks ago, Theranos said it's pulling out of that business entirely, that it's no longer. But I think the only way to think about this, if you have a runaway story, nobody wants to stop and ask those tough questions about the story. So if you have a story that sounds really good to you, test it out on somebody else who doesn't have as much of a vested interest in that story being true, because you want to make sure you get those questions answered before you run away with the story. And I'm going to leave you with one final way in which implausible stories can kick in. Do you guys know any entrepreneurs? Do entrepreneurs tend to be diffident people or overconfident people? If you had to characterize them as a group. I mean, if you're an entrepreneur, you're probably overconfident, right? So let's say you're an entrepreneur. You're an overconfident person. You're looking at a big market. You think you can conquer that market, right? You have this idea to conquer the market. You come to me, I'm a venture capitalist. Venture capitalists, diffident people or overconfident people? Tend to be overconfident people. We think we know the winners. So you have an overconfident entrepreneur surrounded by 3 overconfident venture capitalists looking at a big market. You say, what's the big deal? There are 100 other entrepreneurs all doing the same thing with their little clusters. So you have 100 overconfident clusters all looking at the big market. What does overconfidence mean? Basically, you're overestimating your chance of succeeding, overestimating growth, overestimating revenues, overestimating profits. Do you see what's going to happen? Each cluster is going to come up with a valuation of the company based on the big market. And because you're all overconfident, what you're going to end up with is the collection of your values, the aggregation of your values, is going to be much higher than they should be. You want to call this a bubble, go ahead. But this is a feature, not a bug. This is going to happen anytime you have a big market and overconfident people going after that market. You're saying, what kind of a big market? It could be cloud computing, it could be China, it could be online advertising, it could be pretty much any market you think of. This is going to be a feature, not a bug. And of course, people think bubbles are bad things, right? They wag their fingers and say, oh, that's horrible, you shouldn't allow this. And the question I ask them is, would you rather live in a world run by actuaries? You know what that world would look like? We'd still be in caves. The guy's going to say, oh, fire, too risky. I don't think we can try this out until we've fully checked out everything that can go wrong. Metal tools, no, let's not go there. The stone tools work really well. A world run by actuaries will never see advances. So when you see a bubble, think of it as a feature, not a bug in these markets. So when we start next session, we'll complete this process of storytelling. And then we'll actually start, we haven't valued a single company. It's what, 12 sessions in? Right? We've not done a full valuation all the way through. Next session, I'm going to remedy that. We're probably going to value 20 companies in one session. So, no. See you on Wednesday.
Capex larger than
I got a question regarding stock-based compensation. So I added it back into my DCF. I'm guessing you think that's not the right way to go about it. But why? It's not non-cash. Not having the option to choose the part.
If you give away an equity slice and call it non-cash, then I think it's everything.
What have you got and doing the equity by adding the options again later on? So we're not
Where are you adding the options? This is future options. Where are you adding future options? All you're doing with options is you're looking at existing options. These options you're putting around future options.
what if I add a future option to my equity level? What if I
do you know how many? Because you see the circularity goes up, right? You need to give options next year, 3 years out. To get the value per share today, you need to tell me what your options are. Because options are a function of what value per share you're granting. You can't give yourself. So unless you're willing to adjust the share count today for expected future option grants that you don't know will happen at what price, you're not going to be able to grant future options.
Even though, but at the same time, stock-based compensation isn't a real expense. I mean, it's not cash. It's not cash.
For every day you come in and work for me and I give you 1% of the entire pizza bill, right? My equity is going to go down. If you ask me what the value of equity is, that 1% I will be giving you every year for the next 10 years is essentially less equity I have today. The value of my equity today has to reflect my giving away pieces of the business to you. So even though it's non-cash, because it's a slice of equity in the business, the only way to bring it in is to treat it as if you issued here's the game to play. Act like you issued the options to the market, took the cash and paid these guys, right? Because in a sense, it's skipping a step with the barter system. If you'd issued the options to the market, raised the cash and paid these guys, it would be a cash expense.
Right, yeah.
By skipping that step, you're saying there's no cash expense. That's what I mean by barter system. Is think of it in those terms, and you essentially see that even though there is no explicit cash expense, there's an implicit cash expense.
So why does every sell-side analyst and buy-side
Because they
analyst,
don't do DCF.
they throw in stock-based every time?
Because it's a very bad practice. And in fact, they don't even do it. It's not for DCF, it's for multiples. And their defense is if I do this for every company, I'm at least being consistent. And if every company granted the same percentage of value in options, your multiples are probably not being affected, right? So your only defense is, I'm adding it back to EBITDA for every company. If it's increasing my EBITDA by 10% for every company, the EV to EBITDA multiples across the companies will all come down, but because they're all coming down, and this is where the implicit assumption comes in, they're all coming down by roughly the same percentage, so I'm okay. But the problem with that assumption is options can be in the money, out of the money. Some companies grant a lot of options, others don't. And if you add back option expenses, you're going to find companies that grant a lot of options look cheap constantly. You're going to be overloading in the Twitters of the world because instead of paying traditional cash expenses, they're using options to replace them. They're going to look cheap to you on any multi.